Hi, I'm Tim Kelley from the Montgomery Fund and welcome to this week's Video Insight. Today I want to talk about some aspects of the fund management industry and some of the things that you as a potential investor in managed funds can do to make sure you're getting the best results for your capital. One of the first things to be aware of is how well the funds management industry does on average in earning its keep. A lot of research has shown that on average, while fund managers get paid a lot to make investment decisions, it's not clear that the investors are getting very good value for their money. In particular, the evidence shows that a large percentage of fund managers don't beat the market by a big enough margin to cover their fees, and the investors end up with a lower return than they could have gotten had they just been invested in the index. If you think about it though, perhaps that's not too surprising. Fund managers represent a large percentage of the capital invested in the Australian market, and so there's not a lot of scope for the average fund manager return to be higher than the average market return. In a sense, they're almost the same thing. Now, within that large group of fund managers, though, there are some who will consistently beat the market and earn returns that more than justify their fees. So how do you find them? One interesting fact that comes out of the research is that a large percentage of small cap fund managers do tend to beat their index. So that's an interesting area to think about. But you need to be a little careful with the statistics. The benchmark for small cap funds managers in Australia is usually the Small Ordinaries Index, and that index contains a lot of poor quality junior mining and exploration companies. Over the last 5 years, the Small Ordinaries Index has significantly underperformed the broader market, and we think a simple strategy of just avoiding the poor quality junior resources can allow you to beat that index, but it doesn't mean you'll get a better return than the broader market. Having said that, some small cap fund managers perform very well and they do it consistently. Often these tend to be smaller fund managers that a lot of people might not hear about. We think that part of the reason for this is that having less capital to invest can be a significant advantage for a fund manager. A manager with many billions of dollars to invest has to focus their efforts on the biggest companies in the market, and with all the largest fund managers focused on those companies, there aren't that many of them that are priced at a level that represents good value. So if you're choosing a fund manager to invest your capital, it's important to choose wisely, and one of the best things you can do is seek out managers that are not the household names and that don't advertise in the Financial Review. Have a look at their track record and find out how they go about managing client investments. If you put in the time to do your research, I think you'll be able to find good, smaller funds managers who are likely to do a much better job for you than the big end of town. That's it for now. We'll be back with more insights next week.